All right, we are officially live for another Wealth Building Wednesday. Today is September 24th, and we are still reeling from last week's rate cut and the Fed deciding to not just do a 25 basis point rate cut, but a 50 basis point rate cut. And you know what is crazy? The interest rate market did not change a whole lot when it comes to mortgage rates on real estate. So many people were shocked by that. It actually moved up. And I'm going to share an interesting thread with you guys to break that down a little bit more in how the Fed funds rate and obviously mortgage rates are not as directly linked and correlated as many people thought they would be. The Fed decided to drop rates by 50 basis points. Why are mortgage rates not dropping at that same level? We'll dig into that a little bit more today. We've got some other updates on what's been going on in politics, crazy headlines and news that are just very interesting to talk about real fast on some of the kind of cultural and social fronts. And specifically in economic news, we've got some insights as to consumer confidence. Are we headed for a recession? Is the Fed actually going to pull off a soft landing? They're acting like it. We'll dig in a little bit more there. We got some real estate updates in terms of inventory, where the interest rates are at, and is the residential real estate market uninvestable now? So some interesting things to talk about in today's episode. Mr. Breedwell is out of the studio this week, so I am running solo with you guys, and we've got some quick hits to jump into. Number one, my favorite trader of all time, probably one of the most successful traders of all time, Miss Nancy Pelosi, sold nearly $1 million of Visa stock on July 1st. I don't know if you've been following the news today, but the U.S. Department of Justice has officially sued Visa today, accusing one of the world's largest payment networks of antitrust violations that affect the price of nearly everything, just 3 months after Miss Pelosi, who is, of course, privy to this insider information, decided to get out of that stock. Maybe she was just looking to take some profits, or maybe she got tipped off to some things that the U.S. Department of Justice was going to be doing and how that may impact her holdings. Just another example of why we need some accountability and ultimately a block of the investors in politics from being able to trade in the capacity that they currently are. Other breaking news, Caroline Ellison of FT with her boyfriend, Sam Bankman-Fried, have been officially charged. While she was charged guilty and sentenced to 2 years in jail, an even bigger hit to her, personal bank account, because 2 years, I think, depending on good behavior, she should be able to get out, within 12 to 18 months, something along those lines. She must also forfeit her $11 billion net worth that was also obviously tied up and gained from the fraudulent moves under X. Kind of a funny story, maybe not too funny, but Sam Bankman-Fried is also in the exact same jail block as Diddy right now. And some interesting insights there, nothing specifically tied to, financial markets and institutions right now. However, this is just completely upending Hollywood right now, the music industry, even the country music industry. There's all kinds of insane stuff and weird things going on when it comes to people deleting their entire social media profiles, wiping clean, their tweets, disconnecting from each other, CEOs stepping down, all within very, we'll just say, head-scratching timelines of this Diddy case. And Diddy is facing the same prosecution as Jeffrey Epstein and is currently in the same jail and same jail block that Jeffrey Epstein was at. Some ironic, connections there. I'm very interested to see how this all plays out, just because, one, I want to see some accountability to, the darkness and the evil and the bullshit that is tied to so many of these celebrities and individuals that just think that, as their clout and their celebrity status and, their financial positions make them untouchable. When you go and do some of the things that are being alleged in these court documents and the people that they're being alleged at doing them with, this thing seems to run extremely far and wide and deep in many parts of politics and parts of, Hollywood, acting, the music industry, and ultimately could be tied into finance as well. So follow the money, see where things lead. And ultimately, we're starting to see some pretty intelligent people and some people who are thirsty for accountability when it comes to this kind of, pedophilia, sex trafficking, just, some pretty dark and nasty stuff, being tied into so many of the aspects of our culture and our society. And people are fed up with it. So I'm very interested to see how this continues to play out. Now, we do have, some interesting things taking place on the campaign trail as we are, less than 2 months away from the election, and some interesting statistics with Kamala Harris going from a 20% approval rating when she first kind of got put up on that pedestal to now, with the media's help, mainstream media, her approval rating jumping up to 50%, with essentially 98% of the coverage of her on the mainstream media being positive. The alternative to Trump, 92% being negative. You can see, in my opinion, just how powerful the media is and how much control they have over the average human's mind, and how most people don't do a lot of their digging, a lot of their research. And ultimately, this is a good example of why it is so important to be financially independent, financially free, to take your own destiny into your hands instead of leaving it into someone else's. And most financially independent individuals are relatively free thinkers. They go against the grain, they do their research, they do their due diligence, and that leads them to making the best decisions they can on their business, on their employees, on their, financial goals, based on their own independent research instead of just what the mainstream media or, somebody told them, right? And we saw this last week, Dick Cheney, who has been somebody on the right for his entire career, endorsed Kamala Harris, which ultimately, mind you, Dick Cheney has been an absolute enemy of the left for so long, for so many reasons, a lot of it tied to kind of his industrial war complex, neocon type of stance and positioning, benefiting from a lot of the wars. And interesting that he is aligned on the left, which, says they are not looking to stay and remain in any wars, but obviously we can see what has played out over the last, couple years, 2 wars, potentially, more tension and wars right around the corner, which seems to be aligned with Dick Cheney's MO. We saw an endorsement of the IS of Kamala Harris as well, in addition to many of the mainstream corporate media, big pharma, big corporation, all endorsing her. So interesting to see so many of what have been, labeled and demonized in past election cycles, from the left being openly welcomed and excited to receive those endorsements. I did find it interesting that some data on, and again, I'm not saying Trump is perfect by any means, and nor am I, looking to vouch for his character. What I am looking to vouch for is his policy and how it played a role in our economy during the 4 years he was in office. And obviously, in the last 16 years, we've had all 12 of those years be Democratic, 4 of those years be Republican. And, when we're talking about fixing a lot of the things over the last 4 years, ultimately that were created under a Democratic administration, it doesn't really bode well when you really look at the statistics. Trump's last day in office, inflation was at 1.4%. Gas was at $2.39 a gallon. Mortgage rates were at 2.8%, and the average rent in America was $1,419. Now, at the peak under the Biden, Harris administration, the worst under them, inflation was at 9.1%, gas at $5.02, mortgage rates at 8%, and the average rent just shy of $1,800. So I'm just going based on what I think is going to be best for my real estate investments, my stock portfolio, my ability to buy groceries and continue to live the lifestyle that, I'm looking to live for me and my family, for safety reasons when it comes to protecting our country, our border, our ability to, have a free and open market in society without interference, censorship of free speech. There's a lot of issues that I believe are on this ticket that don't necessarily have to do with the talking heads that represent. It's more of a policy-based thing for me. And I do believe one administration is going to have, better financial implications for many investors and individuals, let alone cultural and societal implications as well. That being said, I am of the mindset that we always make our own economy. Whether it's good or bad, it is always a place that good investors, wise investors are consistently looking for the pockets of opportunity. And I think no matter what administration gets in there, those opportunities are still going to be present. You just got to be open and willing to meet the market where it's at and find out how you can win in that economy for yourself and what investments you're looking to make. Now, there's some interesting things, when you think about how we are, some concerning things that I'm seeing, and Mr. Breedwell isn't here to necessarily give his 2 cents on this and the power of the dollar and the dilution of the dollar. And, but the biggest, elephant in the room is the national debt and the continued attempts of raising the national debt in the name of many of these social causes that they've done a very good job of getting people behind, right? And when you think about, we'll just say for the Ukraine and Russian war and the amount of money that has, been spent on that war that could be allocated if, intelligently utilized in our own infrastructure in the United States, solving things like our education issues, homelessness. I mean, one of the craziest things to me is thinking about the most powerful country in the world can't solve homelessness. But we can change, for example, the Earth's temperature with the Green New Deal if you guys, decide to pay more taxes and we can fund trillions of dollars to do that, right? I mean, there's countless things that we could continue to go through and think about when it comes to America and how amazing our country is, that we have decided to neglect in turn, and what things we have decided to allocate money for, and how that doesn't directly impact us as American citizens, doesn't make anybody healthier, wealthier. We've got some major issues in a lot of areas of our country. And the big elephant in the room is that we are continuing to bury our country in debt. You've seen people like Elon Musk say that America is going bankrupt. And of course, right, we can continue to print our way out of this. And we all know what that does. We all know what that did when we introduced the amount of money into the, money supply post 2020 and how that result played out. And when I continue to see and hear plans and proposals about taxing the wealthy, and what people don't really understand when it comes to a lot of these tax policies and proposals, these are things that are going to negatively impact the middle class and the poor. I'll give you an example. There are 550 US billionaires in the United States, and together they are worth about 2.5 trillion. Now, if we decided not just to tax the wealthy, let's assume that we were going to take away, we were going to confiscate 100% of those 550 US billionaires' wealth. We took it all $2.5 trillion, and we'd raise enough money as a result of that to run the federal government for less than 8 months, less than 3 quarters. If you wiped out all the wealthiest people in the world, took all their money, we would only have enough capital at the rate that we are spending, the debt that we are at, the interest payments that are due. We would only have enough in a current situation, enough money to run the government for less than 8 months. So perhaps our problem isn't how much billionaires have and how even the wealth is for billionaires. Let's not take into account all of the commerce they've created, all the opportunities they've created, all the innovation they've led, all of the benefits that have resulted and the ripple effects that have been, a result of all of their amazing things that earn them that money. But perhaps our problem isn't those billionaires, but how much our politicians negligently spend without any regard as to the results it creates and how it negatively impacts us and our country. I think that is the real issue. When you talk about the insanely bad spending of our hard-earned tax dollars, this is the stuff that people are getting really upset about. And when you think about policy being a real issue around taxation and what certain administrations want to do and not do, these are things that directly impact your investments, your future, your family's future. And, that is something that I think we will continue to take front and center, not only in this election, but post this election, and how a lot of these policies that play out really impact the investments, the security, and the future for so many people financially because of policy. So this is where I think it's really important. Let's remove the talking heads, let's remove the emotion, and let's really start to look at the brass tacks of what these policies logically will do if enacted. And what's interesting when you think about how many politicians, and I'm not saying Trump was good at this either, right? It's so unfortunate and frustrating to see how many politicians give promises on the campaign trail and do the complete opposite or nothing at all based on what they said after the fact. But when you look at the history and the track record of who said what, I know what side I'm voting for based on that alone. And right now we're at a critical stage that we could be headed into some turbulent times. So let's talk about that a little bit and, take a little bit more of a look at the market. So if we were to summarize what we're seeing in the market right now, the current situation is stocks are actually rising again, like this soft landing that the Fed has talked about has already happened. What's interesting is gold is rising. It's hit multiple all-time highs over the last week, as if we are in a major economic crisis. So stocks are rising like the soft landing is happening and we got a bull market ahead of us. Gold is rising like we are in some kind of crisis and this is the safest store of value and backstop. Bonds are falling like the Fed is done cutting interest rates when we just started, not only with a 25 basis point rate cut, but a 50 basis point rate cut. Real estate prices, because of that, are starting to heat back up again. Now, we'll talk a little bit more about what inventory looks like, because as of today, inventory is up 1.6% week over week, and it's up 37% year over year. So will some of this interest rate and monetary easing re-spur some demand in the housing market? And we just saw that let me pull this up. We just saw that based on the Case-Shiller National House Price Index, that's up 5% year over year. So housing is still more expensive, even though inventory is up. Demand and supply are starting to shift a little bit, but that may start to change now that we started to see some interest rate cuts again. And so I think it's very interesting to try and, make sense of all of this, right? And going back to this summary of where the market is at currently, we also see oil prices are falling, like demand is starting to slow. And we're seeing that natural gas and energy prices are rising like demand is growing. So it's extremely interesting because it's hard to make sense of all of this. Nothing adds up here. And when you look at a lot of economists, traders, big firms and funds that have a lot of research, that have a lot of history, that have great track records, and have just been in many of these in and out of many of these market cycles, what everybody's saying is this is one of the least traditional market environments of all time. And when you have the Fed that is calling for a soft landing or already acting kind of like they've accomplished that, but then they start the rate cut cycle with a 50 basis point rate cut cycle, which in history, the only other two times that they have started that have been with the 2000 dot-com bubble and the 2007 financial crisis based on the mortgage. So when you think about that, what are they not telling us? What does this say? And they're essentially cutting rates at crisis levels. In fact, over 100 basis points of rate cuts are priced in for 2024 already. And we're still seeing core inflation at 3% plus right now. So when you look at interest rate futures, they are literally pricing in a recession while the Fed says they are already likely to have avoided one. So there's a lot of stuff that doesn't add up, right? And what does that 50 basis point rate cut? Does it mean maybe that they are trying to play a little bit of catch up and they think they should have cut earlier? Are they looking to, politically send a message that may help or hurt somebody? Is the economy way worse off than they have been letting on? And they're still providing a narrative that may not be in alignment with their actions, and the audio and the video are off? Is it a combo of some of these, of all of these? Nobody can make sense of it. Now, interest rate futures are now pricing in 8 Fed rate cuts over the next 12 months, which is the most since 2008. Now, history says that more volatility is coming for the stock market, for equity markets. And, I think that's here to stay. We've seen the same exact trend that looks to be happening globally as well. Global central banks implemented a total of 28 rate cuts in the Q3 of 2024, which is the most since Q2 of 2020, which is right when what happened? So all major central banks are cutting rates, even as inflation risks are clearly seen as present and material, and that it doesn't feel like they've got it completely under control. So we're going to, be paying a lot of attention to how the Fed and what their rate cut, how it got absorbed into the market and what it does over the next couple months until the next FOMC meeting. And it's interesting, right? Because gold prices are skyrocketing like we're already in a recession. So that's a little bit odd. And so when you just think about, heading into 2025 uncertainty, and again, I'm going to leave this up to Breedwell to talk about his side of the fence, but, on the real estate side, when you think about Fed cutting rates, most people get excited about that. What most people don't understand is just because the federal funds rate is getting lower doesn't mean that banks are going to fall completely in line and in unison with that rate cut. We actually saw rates jump in the, first few hours and days of the Fed dropping the 50 basis points. Because guess what? That was already baked into the market. And so people were looking for more guidance, and it's probably going to hold there. Now, as we head into, these next few meetings for the year and into 2025 and Q1, Q2, I think we'll definitely start to see rates, ease as a result of more of that data starting to play out. And, ultimately what the market ends up doing as a result of that, depending on if we do go into recession or how stagnant certain things become, they may continue to ease those rates to spur and incentivize, some additional demand. And obviously this is just in the real estate side of the market. But volatility is the new normal, y'all. And I always think about when I interviewed Morgan Housel on the psychology of money, and one of the things that he said to me was, volatility is the price you pay for building wealth. And if you can sustain that volatility and even invest through that volatility, ideally, this is where a lot of people make up massive, massive strides in their wealth building and their financial future. And so that is ultimately what I'm looking for. Just be patient, be, very diligent, be very conservative. Think about how you're looking at all of your real estate deals and opportunities and investments as if things are going to get worse and that they're not going to get better in the short term. And if you can weather that storm and, work through that volatility for, a reasonable amount of time and still have your investments make sense, that doesn't put you in any financial bind or position to where it could topple something else or, God forbid, all of what you've been building, now is the time to continue to take some investment risk and to invest during this season. But do it, of course, right, with the data, with the diligence, and with the counsel that you need to feel comfortable taking on some of these risks in what can be. So I'm very interested to see, how we continue to watch the markets play out as a result of this, and, what investors and big, capital is going to do as a result of some of the data we continue to see, roll out. But, for me, I think that this is probably one of the most exciting and opportunistic times in markets we've ever seen. And we'll see, at least in the short term. I wish I would have invested more in 2020. I wish I would have invested more in 2010 to 2012, 13, 14. I wasn't investing yet, before then in some of the other cycles that reflect these kinds of opportunities and volatility and risk, but we're in it. But I do know that, the market is still sorting through a lot of the challenges. And, when we see statistically today, we saw that, where is it? Consumer confidence is at an all-time low in the last 3 years. Obviously, that puts us back into a time where many people were scared and fearful of where we're at, what the economy was doing. And, unemployment is definitely continuing to be something that I would spotlight and continue to focus on. Just some data for you here today. The number of underemployed Americans is growing at a relatively rapid pace. People working part-time jobs while still seeking full-time employment jumped 14.4% in August to 4.8 million. That is the highest level since May of 2021. Since October 2022, this number has soared by 1.1 million people, or 32% over the last 45 years. Such a spike has always coincided with a recession. So again, I'm not sounding the alarm on a recession, but I would just say I have a healthy level of paranoia around the fact that a recession could be around the corner. And depending on, how we navigate over the next, 45 to 60 days going into this election, and then depending on what administration gets in there and what, the market does, capital does in response to what administration is going to be in there based on the speculation of how they think that administration's policies are going to play out. We're going to see some shifting and some rotation and some moving, some people kind of staking where they think things are at, potentially backstopping certain investments or taking risk and, getting more aggressive. But I do think that we're going to see some very interesting opportunities result of this. And that there really could be, based on this healthy level of paranoia that I have, we could have absolutely a recession, no matter what administration gets in there, based on the fact that, we really didn't see one post 2020. And I've been saying this party, when all the dust settles at some point, this party is going to come to an end. And it feels like it's slowly coming to an end. Now, there's a lot of cash still sitting on the sidelines. But at the same time, it's, institutional level and high net worth individual, cash, and it's not the average American. And I do think we're going to see some distress for a lot of people. And when you look at this number on, underemployment or unemployed, this is something that the jobs market, could continue to deteriorate and deteriorate rapidly, which could lead to a lot more of an issue and tie into the potential of a recession going forward as well. So that's something that I'm definitely keeping an eye on there, right? I mean, the Fed's mandate is the two things that we're trying to pay attention to, which is what? Inflation and unemployment. So those are things, and going back to interest rates. Well, let's talk about that for a quick second, because interest rates are actually up since the Fed cut rates last week. In fact, some products have seen interest rate rise 20 basis points or more over the last week, even though the Fed cut rates by 50 basis points. So how is this even possible? Well, let's talk about this a little bit. The 10-year note yield has risen from 3.6 to 3.8% in just 6 days. So since the Fed announced a rate cut, bond prices have gotten crushed. This comes even as the Fed announced a larger than expected 50 basis point rate cut. But why? This is the question that a lot of people are asking. Well, leading into the September 18th Fed decision, the market was fixated on what the Fed would do. And trading was entirely about if the Fed was going to do 25 or 50 basis points. And in reality, right, most people knew it wouldn't matter for price action. And that's something that, a lot of investors, at least real savvy investors, understand. But, a lot of people, when this news broke, expected there to be some drastic shift in the mortgage interest rates, 30-year mortgage interest rates, and they went up. And so this is something that I don't think a lot of people understand, and especially this year and really over the course of the last few years, is the way the Fed has continued to tip their cap on where they're going to be at. The market has gotten overly aggressive in how they utilize the Fed's sentiment and the Fed's potential decision and or their final decision being already priced into the market well before it actually happens. And that's what we saw here. Most people had already priced in the fact that they expected the Fed to do multiple cuts, but they didn't think it was going to be all done in this first one. So ultimately, what my sentiment or thoughts around this are, the market, and we'll just say interest rates, had already baked in the fact that Fed is going to cut 50 to 75 to 100 basis points. So until it gets over that, I don't think we're going to see any major movement in significant lowering of, we'll just say, the 30-year mortgage interest rate. So this was, definitely the market, the banks buying the rumor that they're going to make these cuts and that it was already factored in. Therefore, there was no shock and no total movement on their side, even though it may have been a shock for many on the consumer and the retail side. So we'll definitely continue to, look ahead, even looking ahead to the November 7th meeting. Bond markets are already pricing in 100% chance of a cut. In fact, the exact same debate is happening now as we saw before. Will the Fed cut 25 or 50 basis points? So this is going to be something that you see the markets and you see banks and you see other high-level institutional investors already bet based on the rumors and price in accordingly. And, the main street mom and pop type of investors, most individuals are going to look for movement as a response to what they do. And that may or may not surprise you based on how they respond. So very interesting stuff to kind of keep an eye on all of this. We will continue to keep an eye on all of this. I wish I could get, a little bit more insight from Mr. Breedwell on his thoughts because, that's not my side of the fence. But, as interest rates continue to reduce and we see hopefully in Q1, Q2 really start to be reflected in 30-year mortgage rates and, just in debt in general coming out from different, banks and lending partners, this is going to be a great thing if you own real assets. This will give you the ability to recapitalize deals and pull some cash out at a cheaper rate, right? This may change the terms and structure of some of these banks and their leverage that they're willing to go up to, which might give you more, liquidity in certain recapitalization events. This may inflate your value or at least stabilize your value a little bit more based on the cost of capital being a little bit more affordable to make some of the economic modeling on some of your deals or your assets make more sense. So I'm excited about this, of course. But I did see a very interesting headline today that I wanted to dig into that I found, I don't want to say concerning, but just noteworthy. And it was residential real estate is so expensive that it's no longer investable. The average mortgage rate of 6.1% is now well above the 4.4% average cap rate on a rental property, according to Reventu. As a result, investor purchases of single-family homes are down by nearly 50% since the pandemic high. Let me read that again. Investor purchases of single-family houses are down by 50% since the pandemic high. For over a decade, investment property returns were above mortgage rates in the 2010s. Residential real estate has gotten so expensive that not even investors can afford to buy it. There's no point in taking the risk and having to do all the heavy lifting, management work, expenses, taxes, when you can go and get a much better risk-adjusted return in something that, doesn't require and have all of those moving parts to it. So it's going to be really interesting to see this because we've had rising interest rates and rising prices for 2 years in a row now, which is odd to think about. And clearly this is not sustainable and something is going to have to give at some point. Now, lower rates may provide the necessary relief here, but time will tell. So is single family still an investable real estate asset? I mean, it's looking more and more like a bond now than it is looking like a really great investable, high yielding asset that has produced great cash on cash returns plus a lot of tax benefits, for as long as many people can remember. But again, like all real estate, things go in cycles. I do think that real estate being a core need for human beings is always going to be a great and safe investment, that as long as you got some human being with a heartbeat that's willing to pay you to stay in your property, there's going to be value and insulation to the value of that asset. So that'll be something that I continue to pay close attention on as well, knowing that, the shift in economics right now are really starting to create some challenges, but also some opportunities, depending on, if you're a buyer and or a seller or a holder right now. To me personally, I am getting excited about the opportunities that are out there. And, if you're somebody that's new, just trying to get in the game, and whether that's investing in anything, right? Just use this as an opportunity and a time. And I'm using this as an opportunity and time right now as well to learn more, because I know the more I learn and meeting the market where it's at, the challenges and the opportunities, the more I learn, the more dangerous I become, the more I can earn as a result of that. And the more I can earn as a result of that, the more I can reinvest intelligently as a result of that. And the more I have invested, as long as I don't take it out of the market, the more that wealth will compound over time, the longer I stay in it, right? So using every opportunity you can, every market cycle that we're in, to learn, to find more ways to earn, to find more ways to reinvest intelligently and continue to get more assets invested into the market, or capital invested into assets and into the market, to continue allowing time to compound those investments. That's the name of the game. You don't need to hit a home run right now. You don't go broke making money. And so in times like right now, of course you want to look for those juicy, sweet opportunities, but also just being conservative and modest in how you're approaching these situations, and reasonable. Sometimes it's just about, in volatile times, just finding a way to keep your stance without losing too much ground, maybe gaining a little bit or not seeing too much slippage. But here's what I'll say as a closing statement. I've had a handful of people send me a reel recently of a guy that is basically just getting pissed off, and he's upset that, people are saying you can get into real estate with no money down, and, you don't need any experience, and you don't need any of your own money. And don't get me wrong, I know that is true, that you can do that. This guy's saying you can't, and that the internet is stupid for doing that. And I'll just say the truth is, you can do that. Is it likely for everyone, for the average person? My answer is no. You got to be somebody that is so hungry, so disciplined, so obsessed with finding this right here, which is, you got to find a deal so good, so deeply discounted, so safe, so much of a no-brainer, that someone with zero experience and no money can still find a way to get money to want to be involved in that deal, because there's no way to lose on it. That's what you have to do. And that's what these kinds of markets give you the opportunity to go out and find. In 2010, post-financial crisis, when I got into real estate, I had no money. I had no experience. I was trying to learn a lot. I was trying to read. I was going to seminars. I was, had a mentor, all that kind of stuff. But I had zero experience and I had no money. But I found my first flip at a no-brainer price that was so good that my zero experience and my zero money, I still found a way to fund 100% of that deal and 100% of the construction costs to flip that house and make a six-figure net profit after paying off all of the people that invested in that deal. So again, it's possible. You just got to find a really great deal that makes it a no-brainer, that money feels like they can park their capital in it and still feel safe and still feel like they've got a way to get the return that they're looking for. And there's a lot of ways, obviously, that you can mitigate that risk with a good team, a good plan, conservative underwriting, all that kind of stuff, right? And obviously a very low basis into a great deal. Those deals are out there. Now, again, they're needles in a haystack. They don't always come around, but they're out there in really bad markets, and they're also out there in really good markets, right? So finding the people with high levels of motivation, high levels of distress, and finding a way to create a win-win and still find a way to get investors to feel comfortable in that deal, it is possible. Don't let anybody tell you that it's not. So to that guy, I say, I understand his point, and I would acknowledge and agree that it is not common for 95% of the people that are trying to do it and approach it that way. At the same time, I would say there is a group of individuals and a percentage of people that don't have any experience, real experience. They haven't gotten a deal done yet, but they've been reading a lot. They've been listening to podcasts. They've been going to meetups and networking. They've been putting, the time and effort into building a relationship-based team that can help them with the investment strategy that they're looking for, that they're building capital relationships so that when they do find that amazing opportunity, right, it's just connecting the dots on that. And so if you're a new investor and you're thinking about doing that as well, whether that's in single family or you're a new investor and you're trying to break into the commercial side, it's possible. And anybody that tells you it isn't is trying to, I think, steal it's the word I'm looking for. Anybody that tells you that it isn't is generalizing in a way that I think is doing a disservice to the people that are really hungry and are putting in the work. And I don't want anybody to think that they can't do that, but there's a lot of boxes you got to check if you're going to get into real estate using none of your own money, having no experience. And that's something that I think seasons like we're headed into are more opportunistic and possible than in markets like we've seen over the last few years.